Good afternoon, ladies and gentlemen. This is Richard Hopkins speaking. I'm Head of Fixed Income at AFME, where I also lead our work on European securitization. This is our first member call of 2018, and the subject is simple, transparent, and standardized securitization, full steam ahead. Thank you all very much for dialing in today. This is being a very popular call. We've had around 130 people registering for this call, which is great. This is also the first call that we're doing with our new system. So hopefully everybody is sitting in front of their computers and listening via their computers rather than via the telephone. And I hope the technology is all going to work smoothly. We are going to divide the hour, as usual, into a little bit of presentation and then an opportunity to ask questions. The questions need to be asked by typing in the questions into your computer, and then they'll show up on our screens here, and we will digest them and feed them through. So it's my pleasure to be joined today by two of my AFME colleagues and three guests from our member firms. My AFME colleagues are Anna Bach, Associate Director, who works very closely with me here in AFME's London office on securitization matters, and also our close colleague Pablo Portugal, Director in our Brussels office, who leads on the advocacy and procedural aspects of our work in primarily in the Brussels bodies, but also in the key member states around Europe where these decisions get made. As well as my AFME colleagues, I'm delighted to be welcomed by Janet Oram, Head of European Asset-Backed Securities at Blackrock, Rob Ford, who is Partner and Portfolio Manager at 24 Asset Management and also Vice Chair of the AFME Securitization Board, and Harry Noutsos, Global Head of Asset-Backed Securities at ING. So we have three varying, diverse, and extremely experienced and knowledgeable investor voices here today to share with you not just the dry details of where we are in the regulations, but also their views on what this actually means. So I will stop now and hand over to my colleague Anna, who will chair the rest of today's call and will walk us through a few slides and until we get to the Q&A session at the end. So Anna, over to you.
Thank you very much, Richard, and indeed welcome everyone on that call. On that call, we'll cover very briefly some market figures, and then we'll move maybe to introduce where we are in the process on the STS securitization going forward. And then we'll also have a bit of a part for the perspective from our guests to speak about, and at the end we'll have some time for Q&A. So starting quickly with the market overview, I think for those who are actually following securitization market, we don't have really much changes or any drastic changes since last years. The market is still extremely small comparing to where we were before 2008. I think at the moment the figures are somewhere. The figures we have here are for the end of the quarter. Q3 2017, and at the time the figures was just under 100 billion when we talk about European ABS issuance. So it is really small. I think the trends are remaining the same for that. So not much changes since 2016 really. And I think, well, we can only be hopeful that 2018 will be a little bit better, but of course it's hard to speculate at this point as we're just entering 2018. Now, moving forward to an actual STS framework, after a process that's lasted nearly 4 years, we have seen now that both STS regulation and the CR amendment, they have been published in the official journal of the EU. And that has happened on the 28th of December last year, 2017. And both regulations, they enter into force on the 18th of January 2000. Well, actually, it should be 17th of January because we should include the date of publication. So it should be 17th of January 2018. I apologize, it's my mistake in the presentation, but it's 20 days after the official publication in DOJ. So those two enter into force, and that is a formal conclusion of the level one process. So STS regulation and CRR amendment are actually effective from the 1st of January 2019, which means that they apply as a law from the 1st January 2019, and all the obligations that comes with them would be applicable at that day. And that also means that since we concluded the level 1 process, the doors are now open for the STS framework level 2. We will come back a little bit more into details into what level 2 process is and how it works at the end of this presentation. But just for the time being, maybe as a quick run, the level 1 text sets the deadlines for both EBA and ESMA to draft any technical standards and guidelines, so more detailed regulations, which have been mandated by the level 2, so the STS regulation and the CRR. And the ESAs are due to submit most of those technical standards either 6 months after the entry into force or 12 months into the entry into force of the level 1 legislation. There will be also some remaining reports and further work to be done that has a longer deadlines, but for the time being, level 2 is really the 2018. And then the technical standards will need to be approved by the European Commission, as well as by the European Parliament and Council before their finalization. As I mentioned, we'll go back to the more detail of the level 2 process shortly. And now briefly touching on some of the key outcomes of the STS work. So on your slide, you will see the list of points divided by topics and whether we think the outcome is good or mixed or still problematic. So I think on the risk retention, we can say that the outcome is good. Most of the controversial proposals that have been put forward by the Parliament, namely raising the risk retention rate to 10 or 15, on some point even 25%, this is gone. So we say that the outcome actually is quite fine. The same applies for some of the restrictions on the originators and issuers. Also, the most controversial proposals have not been accepted in the final text. On the private transactions, we mark it as a mixed outcome. This is mainly because the work on the private transaction is still ongoing. It's going to be largely dealt with the level 2, but at the same time there are provisions in the level 1 text that are accommodating to a certain extent the private transactions. Moving on to investor name give up, again a good outcome. So this has not made its way through to the final text. On the other hand, the 3 problematic issues are the adjusted standard for the legacy deals. I think we'll also speak about this with our guest speakers a little bit later, but indeed there is still quite a lot of controversy going on there. Same applies for the grandfathering, for the risk retention, transparency and due diligence, and the treatment of the third country securitizations. These are really the key, I think, problematic issues that are still remaining in the STS level 1. Maybe finishing on the more positive sides, ABCP's maturity limitations, a good outcome. We also have seen that the negligence standard has been incorporated into a level 1 legislation, which in the context of penalties is definitely a positive development. Mixed outcome on the self-certified mortgages and the purchase portfolios. This is still something that is probably needs some time to settle. People understanding about an interpretation that's maybe a little bit more tricky, and the treatment of ABS trading in third countries. This is an ongoing item because it is in the CRR and it's in the text in the part that actually has not been covered by the amendment. Though it has some consequences on the ABS trading in countries like US, for instance. So this is still an ongoing process. On the CRR side, outcomes for 2017. So I'm at the slide number 6. I think the good outcome is the hierarchy of the approaches and the conditions to use the SEC IRBA, especially on the last point. This was our big ask. We spent quite a lot of time with the policymakers talking about that. So basically, the level 1 text opens a door for wider use of the SEC IRBA methodology to calculate capital. Again, this is actually quite a point that will be still need some work on the level 2 process, but indeed a good outcome that we have this option. Calculation of the RWA, so the capital calculations. This is problematic. I think they remain the charges remain still quite high comparing to other similar products. So definitely something to focus on in the future. Moving on to slide 7, priorities for the level 2 work streams. So as I said, the level 2 process has begun, and there are a lot of mandates. So more than, actually in total, it's more than 30 mandates under the STS and CRR regulations. Mandates means that EBA, ESMA will need to produce the technical standards, and we have seen so far several consultations that have been announced. So there is a consultation on the risk retention regulatory technical standards by the EBA, and this is a process that will last until the 15th of March this year. Similarly, there is a consultation on the homogeneity. This also includes the regulatory technical standards as well, coming to March 2018. And of course, AFME will be responding to those two. From the ESMA side, we have seen a chunky consultation on disclosure requirements. This one includes regulatory technical standards as well as the implementation technical standards, as well as a consultation on the data repository and templates. So this is quite a lot of work on this one, and this consultation similarly runs until 19th of March. Together with those two, we also see there's a consultation on the notification on the STS itself. So these are all the rules that governs how the notification of what is STS securitization should look like, and it also includes the template. So a little bit more technical work here, and similarly, it's a consultation that runs until March. And we are expecting to see the STS criteria guidelines consultation shortly. Well, shortly, probably in the second quarter of this year, as well as a very important consultation from the EBA on the reg capital issues. So this would include a consultation on the internal models, the use of the proxy data, and the purchase receivables approach. Similarly, we expect this happening in the second quarter of this year. So definitely busy time ahead. For non-STS part, but very closely related to STS, is a Solvency II. I said non-STS because it's not an officially part of the package, but it very closely ties with the STS regulation. There are still some challenges remaining. At the moment, the Commission is looking into the risk factors for securitization under the Solvency II regime. Our position on this one remains that the Commission, we urge the Commission to pursue a reform that adjusts the prudential framework for securitization to levels which are comparable to the treatment of other fixed income products. for instance, covered and corporate bonds. AFME has undertaken some time ago a survey of the insurance investors to provide their views on the Solvency II, and this survey was I think it was quite successful. If anyone is more interested in more details on this one, we're more than happy to provide, but I'm afraid I don't have time to really focus more on the outcomes of this one. And we have recently seen some very helpful interventions from the ECB. Talking about the Solvency II, basically it was Ifmersh, I believe, who said that an updated calibration should consider the difference in the risk portfolio and tolerance between insurance companies and banks, and capacity of the STS criteria to capture a lower risk profile in securitizations. So this has happened in 2017. Solvency II pretty much still ongoing, and we need to pay a close eye on this one. Similarly, we have seen some encouraging news on the EMIR regulation. Hear something from Rob and Harry. Janet?
Okay, so we finally at the end, which is nice, because at least we know what we're. I guess the idea behind this regulation was positive, to get the market started again. The resulting text has got rid of a lot of the things that caused the most amount of stress over the last few years. So we've ended up in a better position than perhaps we thought we might have done a couple of years ago, or perhaps even 6 months ago. I guess it remains to be seen how successful this actually is. And one of my concerns is, okay, this has been going on for about 4 years. We still have the insurance companies where without a date for which that actually this is going to be settled in terms of so we're still not in the position where we have everything set and investors are, you know, all able to look at this market with some certainty as to how it's going to look going forward from a regulatory perspective, and therefore make a decision as to their strategy for investing in ABS going forward, which is unfortunate, but there are some positives. In terms of where it came out from an investor perspective, we've been managing AFEs for some time, so for the last few years we've been under the due diligence and the risk retention requirements for a number of our funds. So from that perspective, what the obligations on us as investors are just much wider in terms of the funds they apply to and the entities as investment managers they apply to. But in terms of what we actually have to do, there's not a huge amount of change. I guess some of the issues are going to come down to interpretation, and what we haven't seen on AFMD, largely because CMU was kind of in process, is lots of guidance, lots of interpretation, all the rest of it. So perhaps that's what we start to see going forwards, because I think Rob wants to comment on some of the interpretation points, but there's clearly still a lot that is still unknown. Rob, did you want to step in on the interpretation?
Yeah, I was just going to say, shall I pick up there? And apologies if I repeat anything. We dropped out from your call for about 2 minutes, so we missed a little bit of the end of Anna's comments and the beginning of yours, Janet. So I'll just pick up with a couple of my points. I think perhaps echoing some of the things I just heard the end of you saying, Janet. From STS point of view, I think generally overall it's a really good thing. It means that we've finally got, you know, a level of official buy-in from the regulators and policymakers. And whilst perhaps some of that label that securitisation has acquired over the years will never go away, we do now have a framework constructed by the regulators which they consider to be safe. And whilst those regulations, as Anna pointed out, are far from perfect right now, they do give us at least a degree of certainty, and that means we can start to move forward. You know, a couple of problems, as Anna mentioned and as Janet mentioned. You know, legacy deals and grandfathering. Right now, all of our portfolios are made up. You know, 100% of our portfolios are made up of essentially non-qualifying for STS transactions, and it may be that few of those might ever qualify, mostly because they were constructed before many of the technical parts of the rules were created, or even have been created, as we're still waiting for many of those over the next year or so. And so whilst many of them might actually be STS in spirit, they may never be in practice. that may or may not be a problem. It depends on the types of investors that own them, and obviously it depends on the final outcome of how the grandfathering rules work, particularly for those investors who are capital constrained. Insurers in particular, under Solvency II, and the banks under the CRR, and as to how those grandfathering rules finally pan out. Talking of interpretations, I guess that brings me on to due diligence, and for me, it really is about interpretation. You know, I've said many times that unlike any other market in the world, ABS investors, you know, now have to meet a predefined set of investment guidelines before making any investment, as well as on an ongoing basis. And in practice, whilst they're not dissimilar to what we already do and what has been in regulation for the past few years, it shouldn't be a major problem. But we do have the uncertainty of how they will be interpreted by the different national regulators. That's currently unknown. And whilst there's some helpful phrases in the regulations, such as investors should carry out a due diligence assessment commensurate with the risks involved, again, we have no idea as to how that level of commensurate should be assessed, particularly given that we have a whole different scope of different national regulators across Europe. We're an asset manager. Harry's a bank, and regulated in Holland. Blackrock are an asset manager regulated here in the UK, I assume, for their UK operations, but in the US by their US teams, and clearly different interpretations from different regulators. And equally, our clients come from numerous different jurisdictions. So if I'm investing on behalf of a European, let's say it's a German client or a Spanish client, will I get two different interpretations of the rules from the German regulators and the Spanish regulators? And do I have to worry about them, or do I, because I'm based in the UK, only have to worry about the UK regulator? And of course, that brings up the obvious issues of what might happen under Brexit. That's just the broad level, and then when we get down to a deal by deal level, how do we interpret that level, that word commensurate? You know, for example, on a new deal, whether I was investing at the senior or the junior level of a deal, I'd expect to analyse, you know, a broad scope of credit factors, not too different from those that are listed in the regulations. But perhaps for a secondary deal, maybe a deal that I'd already invested in, a seasoned, let's say, AAA piece of a well-known issuance program, you know, what would be considered commensurate? Were I to do a brief assessment of the main key performance indicators, is that enough? That would give me reassurance that the deal's performing well, that I'm well protected with my current credit support versus the performance metrics such as losses and delinquencies, and looking at those, given perhaps say the expected life of that transaction, or alternatively, if I was looking at a junior note in a deal, perhaps a primary or a secondary deal, maybe from a less familiar program, I'd expect to do a huge amount more detailed analysis, including, you know, perhaps similar to the analysis I might have done when it was a new issue, including analysis of the loan-by-loan data, scenario tests, stress testing, etc. And where I'm uncertain at this point in time is how those rules are going to be interpreted by all of the regulators. As far as I'm aware, there's no plans out there for any technical standards to be issued. So I think for those of us that are experienced in the market, we'll carry on as we are. But it does leave a little bit of an empty space for potential new investors to come into the market. It's a huge hurdle for them to potentially overcome, and I do worry that we won't see a growth of the investor base in the marketplace, at least at a direct level, with the level of the hurdle that investors might have to overcome.
Actually,
from me, I think. Go ahead, Janet.
Sorry, I was just going to pick up one point you made on sort of regulatory oversight from the investment perspective, so not necessarily at the deal level. So we've already seen in AFMD, we've got clients in different countries who are managing their assets in AIFs, and actually the requirements that what they need from us as their delegated asset manager has been very different between jurisdictions. And actually in some jurisdictions it's got to the point where we have just had to agree that they will not invest in ABS because their regulator has interpreted the rules in such a way that actually from a pragmatic perspective as an investment manager, it just wasn't, we just weren't able to comply with what they needed from us. And so we've already got that in evidence in AFMD, and obviously no one's really focused on it because it was going to be taken over by the CMU. But that's a practical example of where this kind of problem arises.
Yeah, couldn't agree more.
Great, thank you both, Janet and Rob. Now, Harry, do you have anything that you'd like to say? I'm sure.
I try to not to repeat anything that has been said, and a lot of things have been covered. First of all, good afternoon, everybody who's on the call and listening. I think your question, Anna, was the best and worst outcome of STS framework so far. I would say if I start, what would be the worst outcome is that the framework that is in place, the remaining bits and parts of the regulation that need to be, let's say, amended doesn't happen in time or doesn't happen at all. And then we are what I call, we have a table that has one leg, and that is not a very stable table. Therefore, in my mind, STS, the worst thing that could happen is to stay as it is, and there is the urgency is kind of dropped. The best thing would be that in the meantime we fix the investor base, we enhance and enlarge the investor base. We fix the risk weights and the STR to make it again beneficial for issuers to issue ABS, not only for funding but also for capital purposes, which will reduce slightly their issuance under cover bonds. And then as long as more issuers start using again ABS, that increases the market, because the utility of any market is that it needs to be something that it's liquid enough for investors to be willing to participate, and on the other hand is broad enough for issuers to find a use. And if it doesn't serve neither the issuers nor there is a large enough investor base, then the market in itself is not very useful as a tool for prosperity and for growth, which is what the European, let's say, regulators wanted. So in my mind, I think the first hurdle is there, and it was a very important hurdle, as two previous guest speakers have said before. But hopefully the ball is not dropped. People are as focused as were before. We get the last bits in place as soon as possible, because time, unfortunately, is against us. And then I think the best outcome would be that the market recovers to a healthy size.
Great. Thank you very much, Harry. I think we will now open also a floor to members if they would like to send us any questions. And in the meantime, I will turn to my colleague Pablo. As mentioned earlier during the presentation, we have the level 2 process starting. Well, actually, it started already. And a question to you, Pablo: how the level 2 standards are developed and approved? What's the role of the Commission now and the Council? If you can walk us through the different steps of this one complex process.
Sure. Thank you very much, Anna. I will say a few words about the level 2 process. The first thing to note is there are different types of level 2 instruments involved. So each mandate in the level 1, the primary legislation, needs to be reviewed to see which level 2 instruments are being referred to in each of the mandates. So, for example, one type of instrument is the delegated act, where the Commission is in the lead and largely responsible for producing that instrument. And other types of instruments are technical standards, and these feature a lot in the securitization regulation, where the European supervisory authorities are in the driving seat and hold the pen and effectively draft them, as we've seen from the consultations of ESMA and the EBA. They include draft text already that will become legislation. So those are the regulatory technical standards and the implementing technical standards. Maybe just a few words on how they are drafted and endorsed, these instruments. I'll focus a bit more on the technical standards, which are the ones that feature more in the regulation. In this process, the ESAs hold the pen and are responsible for the drafting initiative. Once they finalize their draft standards, following the consultations that we have at the moment, they are sent to the European Commission, and the European Commission will then forward them to the European Parliament and the Council. So within 3 months of receiving the RTS, for example, the Commission must decide whether to endorse it and adopt the RTS as is, or whether it wishes to amend an RTS put forward by ESMA or the EBA. And there are different procedures depending on what the Commission decides. So if the Commission wishes to amend a draft RTS or not adopt it, it must first send the draft RTS back to the ESA responsible, explaining its decision. And the ESA, let's say, for example, ESMA, then has 6 weeks to amend and resubmit the RTS based on the Commission's comments and send it back. If the Commission decides to adopt the RTS without amendment, then the European Parliament and the Council have a 1-month non-objection period, it's called, which was to consider the RTS. And this period can be extended by another month. And if the Commission adopts the RTS with amendments to the ESA's draft, then the non-objection period by the Council and the Parliament is 3 months. And that can be extended by another 3 months. So as we see, there are different processes depending on how on the nature of the instrument and whether it will be immediately adopted or subject to amendments when the Commission receives it. I will just say a few words on the role of the Parliament and the Council. They are obviously responsible for scrutinizing the level 2 acts. And I think in particular, they will check things like ensuring that there is compliance with the level 1 mandates in both the spirit of the level 1 mandate and the legislative intent. And I think in particular, the European Parliament has demonstrated to be quite sensitive to that, to ensure that there are no deviations from the legislative intent that was agreed in politically sensitive areas. And we know what those are in relation to this regulation. For instance, in the recent MiFID process, the European Parliament, did exercise a lot its scrutiny rights and was very active in sending letters to ESMA and the Commission. So that's important to keep in mind here. They will also review that what the ESAs have produced is proportionate, that it follows a good cost-benefit analysis, and the ESAs are required to accompany their draft RTSs with a cost-benefit analysis. So those things are important to keep in mind. My personal view is that the Commission is generally not inclined to amend an RTS unless there is strong pushback from member states or from the European Parliament or the industry, asking for elements to be amended. So we should keep that in mind. And in the case of this regulation, we do have a kind of tight implementation period this year, so I imagine it would be in everyone's interest to ensure the process goes smoothly. The industry has an opportunity to influence through the consultation responses. Obviously, there are also public hearings that are being scheduled, and the regular dialogue with the ESAs. The final point I would note, responding a little bit to the comments from Rob and Janet, is that in relation to the concerns around member states having divergent implementations and interpretations, these are very sensitive to that because they have a mandate to ensure supervisory convergence in the EU. So they also have the possibility on their own initiative to issue guidelines and recommendations, which may not be mandated in the level 1 text. So that's at the discretion of the ESAs. And those instruments can be used to really recommend to member states certain procedures to ensure that there is harmonized implementation across the EU. And member states have to inform the ESAs whether they will not comply with a guideline, for example, which are non-binding. So that's important to keep in mind. If there are concerns around inconsistencies, the ESAs may well issue these instruments. A final point to note is that there is a review of the regulations scheduled for 2022, and that might seem far away, but I think this regulation is particular because it's not just about regulating a market and activity, ensuring it doesn't cause problems. It's also about ensuring that the market recovers. So success, I think, will be judged on that basis there. And if the STS regulation has not been successful in bringing back securitization, I think they will listen closely to that when it comes to the review.
Thank you very much, Pablo. And yes, indeed, we will hope that the authorities will listen to us. Do we have any other questions from the audience?
Please, please don't be shy. And one advantage of this new system is I don't think you have to say who you are to ask a question. So there's no need to be nervous about asking a question that you think, might be too easy. So please don't be shy in asking questions. In the meantime, while you're all thinking about that, I'll throw a question into the mix. One of the problems with the timetable with all the level 2 work, of course, that we knew was going to be a problem is that not all the level 2 pieces of secondary legislation will be ready in time for the coming into force of the level 1 text on the 1st of January 2019. Do people think that's going to be seriously problematic?
I guess we'll just get on with it.
Very honest answer.
Well,
yes.
I don't think we're not in a position to just say, well, sorry, we can't do anything. So we're just going to have to make the best of a bad job. If there are things that are unknown, then we'll just have to work around them. I think in terms of, the really key one for me was the risk retention. And having looked at the EBA's consultation, I think that the main issue that I wanted addressed was the continuation of the guidance in the previous RTS, which is what all the CMBS transactions have relied on. And that's very much in there. And so it looks like that's going to get carried through. I guess the one thing that also was one of the most important things for us in this whole process was making sure that on the 1st of January 2019, we could continue to hold our existing assets. So everything that we own that's, US securitized credit and clearly not in compliance with any risk retention in Europe anywhere is not subject to fire sale or subject to, needing to leave the portfolio. So in terms of where we have got and things we do know, that was, probably our biggest ask and the most important thing that we needed to get nailed down, which we're quite happy did get finalised. Sorry, that wasn't a very good answer to your question, but pragmatic one.
But that's a good answer.
I'll just note.
This is Rob. I would perhaps just to add to that, I would I would say, in general, I'll agree. I think we certainly will get on with it. We've been getting on with it for the last 5 years, and whilst issuance hasn't grown significantly, it is still growing. Last year, to my knowledge, was a record issuance year, albeit only slightly. So I do think we will. In my previous comments, I didn't want to be overly negative. It was just pointing out the concerns about the interpretations of those rules, and I think that will probably be ongoing until we get any finalisation of the various technical standards. And if there's a mismatch in the timing of the initial rules coming into force and then those technical standards being finalised, well, so be it. We'll get on. What I would say is I think that the signs for now, to me, appear to be very healthy. We've had excellent levels of engagement with potential issuers, well-known regular issuers in the market who are out there at the moment, who are doing issues today, who have all indicated that they will be very supportive of issuing under the STS regime where they can, and where the assets and where their various other factors will meet the STS criteria, that they'll be very supportive of issuing under the STS label. And I think that's a really, really good start. Those names are well known, familiar to those of us that are regular investors in the marketplace, and to get those issues in as a strong base for issuance going forward, I think is really important, and that will set the platform for other issuers to come and join the party and to build out where they can. For those issuers that can't issue under STS, it will be very much business as usual, and we'll carry alongside. I would hope the vast majority of the more overarching regulations that are out there are not generally dissimilar to standard market practice today. So I think the future certainly has a good opportunity of being rosy, and those little mismatches are small details that might just hold things back a little bit, but I don't think they're going to be major obstacles.
Great, thank you, Rob.
I think somebody asked a question about just recapping briefly the slide on EMEA, slide 9.
Yeah, sure.
Because apparently the line went dead for a couple of minutes at that point. So, Anna, do you want to just take us back through that?
Yes, so very quickly, again, the EMEA in general, there is an encouraging news as the Council General approach that is now that now proposes to maintain the status quo. So that means that the SPVs would remain to be classified as non-financial counterparties, and that also means that they would, in general, they would not need to comply with the margining and clearing obligations. I said in general because if we're looking in a very nitty-gritty, there are situations where SPV may still fall into these obligations. Maybe there are some issues with the definition of the group, but I think for the purpose of this call, as a general rule, the SPV would not be classified as a financial counterparty. So to recap, in the Council General approach, the Article 1F has been removed from the definition. So the SPVs, SSPE have been removed from the definition of the financial counterparty. And also we noted that there has been some helpful interventions from the ECB on this point. But saying all of this, we still need to remain alert on this one because the process is not finalized. We're still facing discussions in the European Parliament. So let's say it's ongoing, but heading into the right direction. I think I don't see any other question. I guess if we have any other closing remarks, we can. Pablo, anything else from your side? Otherwise, we can.
I was just going to note before that if the implementation deadline looks impossible to meet, there's always a possibility to push back the date. They've done that, but that is really a last resort, and it has to be very strongly justified. They did that in relation to MiFID, for example, but that was really because the deadline was not going to be met. So it's not easy to reopen the level 1 text, but just to mention that for completeness.
Thank you very much. Rob, Harry, anything else from you to finish off?
Yes. Sorry.
Please? Yes.
Sorry, I had no kind of very funny noise for a second, and I couldn't hear what was said.
Harry, yes, I was just asking if there's anything at the end that you would like to add.
Yes. I would like to say that we shouldn't be, as everybody said, we shouldn't be complaining. We have regulation. We didn't have that 6 months ago, 3 months ago. So from that side, I think it's positive. I think once the ECB stops being so accommodative in various ways of funding, whether it's TLTRO or QE, and hopefully SRT regulations allow back the ABS to be used not just for funding but also for capital optimization, then I think we might see, in combination with STS, a comeback of the ABS market. And given that the STS has all these protections in place, hopefully when the next downturn is around, our market is not affected, but it's actually strengthened by proving to be as resilient as it has proven to be during the last decade, but unfortunately tainted by the name. So I hope next time around, when there is a problem, that doesn't show up in this market, and we can actually make even the biggest skeptics comfortable with. And I think that would be very positive for the market overall.
Yes, agreed, Harry. So thank you very much. And I think Richard wants to mention something.
Yeah, just very concluding remarks from me. Just to thank everybody for dialing in today. I'm sorry for the technical glitch in the middle of the call. This is the first time we've used this particular platform to hold these calls, so we will be investigating that. Hopefully it's worked as a practical matter as a whole. The slides will be posted to the AFME website shortly, along with a recording of this call, I think, yes. So if you want to download an audio recording, you can then listen again. And if there are any bits that you think you missed, that's a chance to do that. And just very lastly, I would say, as you've heard, there's an awful lot of work to be done on the level 2 work. We have 2 big responses to do to the EBA on risk retention and homogeneity, and 2 big responses from ESMA on disclosure and on STS notification. Several aspects of the disclosure response in particular are quite technical, and we really are looking for a lot of help from members who are familiar with the technical aspects of reporting, whether to the existing European data warehouse or to their own websites. So there's a lot of sort of technical work there that we need help from members to pull together. So while we're very grateful for all the engagement that we've had from members in getting this far, and we have come a long way, we are, I'm afraid, going to still be reliant on your engagement for this secondary work, which in some ways is certainly just as important. In some ways, it's even more important than the level 1 text. So if you'd like to get more involved in our work, please get in touch with me or Anna. We'd be delighted to have your input. So if there's nothing else, I think we can wrap up for today.
I think so. Thank you, Richard. Thank you, Janet, Pablo, Rob, and Harry, and thank you everyone on the line or on the platform. And we'll speak to you soon.
Thank you, Anna.
Thank you, AFME.